Most people believe that if they ever need to deposit a large amount of cash into the bank, the smartest and safest thing they can do is keep it just under $10,000. It sounds careful, it sounds responsible, chuckles. And for years, that idea has been passed around like trusted financial advice between friends, neighbors, coworkers, and even family members. Someone hears it once, repeats it with confidence, and before long, it turns into something that feels like a rule everyone understands. Surprised? But what most people, especially retirees, don't realize is that this exact habit can create the very problem they were trying to avoid in the first place. In fact, the moment someone starts breaking deposits into smaller amounts specifically to stay under that number, they may unintentionally step into something federal law takes very seriously. And the most surprising part of all is this: the people who get caught in this situation almost never had bad intentions. They aren't hiding money. They aren't involved in criminal activity. They're not laundering cash or doing anything illegal with it. They might have sold a vehicle they've owned for 15 years. They might have received help from their children. They might simply be moving their own savings from one bank to another after decades of loyalty to the same institution. These are completely ordinary life events. But when those transactions happen in a certain pattern, the banking system doesn't see the life story behind them. It doesn't see retirement. It doesn't see grief. It doesn't see family support. It sees numbers. It sees dates. It sees timing. And sometimes those numbers, when arranged in a specific way, create a signal that raises questions. Welcome to Immigration Alert Center. Today we're going to carefully unpack how the $10,000 cash deposit rule actually works, why it's one of the most misunderstood financial rules in the country, and how simple misunderstandings can create unnecessary stress for honest people. By the end of this discussion, you'll understand not only what the rule really says, but how to handle your own banking in a way that keeps everything clean, clear, and uncomplicated. Hi, I'm Sofia, and here on Immigration Alert Center, I spend a lot of time researching financial and regulatory rules that tend to catch retirees off guard. Not because the rules are secret, not because they're designed to trap people, but because the way they actually work is often very different from the way they're described in everyday conversations. Over the years, I've noticed a pattern. Certain pieces of financial advice spread quickly, especially in retirement communities. One neighbor says, "I heard you should never deposit more than $10,000. Another adds, "If you keep it under that, the government doesn't get involved." Someone else suggests depositing $9,900 just to be safe. The numbers may vary slightly, but the message is always the same: stay under the threshold. The problem is that this advice focuses on the wrong thing. Let's first understand what the $10,000 rule actually means. In the United States, banks are required by federal law to file something called a currency transaction report, often abbreviated as CTR, whenever a customer deposits more than $10,000 in cash in a single transaction. The key word here is cash, not checks, not wire transfers, not electronic transfers between accounts. Physical cash, paper bills, and coins. If you walk into a bank and deposit $11,000 in cash at one time, the bank automatically files this report. It's routine. It's automatic. The bank employee doesn't ask for your permission. They don't accuse you of anything. In most cases, they may not even mention it. The report is simply transmitted into a large database used to monitor significant cash movements within the financial system. Every single year, millions of these reports are filed. The overwhelming majority of them lead to absolutely nothing. No investigation, no phone call, no follow-up. They are simply records. This reporting requirement was created decades ago as part of anti-money laundering laws designed to detect large-scale criminal activity. Things like organized crime operations, drug trafficking networks, or other serious financial crimes that historically relied on moving large amounts of physical cash. Criminal enterprises often used cash specifically because electronic transfers create clear digital trails. So regulators built a system that automatically records large cash deposits. But here is the most important piece that many people never hear. The report itself is not an accusation. It does not mean the government believes you did something wrong. It does not automatically trigger an investigation. It is simply a record that cash above a certain amount moved through the banking system. The confusion begins when people hear about this rule and decide the smartest move is to avoid triggering it. Somewhere along the line, someone reasoned, if the bank only reports deposits over $10,000, then I'll just keep my deposits under $10,000. On the surface, that seems logical. If the goal is to avoid paperwork or attention, staying below the line feels like common sense. So imagine someone has $11,000 in cash from selling a truck. Instead of depositing the full amount, they deposit $9,000 today and $2,000 next week, or perhaps $8,500 now and $2,500 later. Maybe they split it between their own account and their spouse's account. Maybe they visit different branches. Each individual deposit is under $10,000. It feels careful. But federal law anticipated that exact behavior. When someone intentionally divides money into smaller deposits to avoid the $10,000 reporting requirement, that behavior is known as structuring. And structuring is itself considered a violation of federal law, regardless of whether the money is legal. The irony is painful. A person who earned their money honestly, paid taxes for decades, and simply wanted to avoid unnecessary attention can accidentally create a pattern that looks suspicious to automated monitoring systems. Modern banks use sophisticated software designed to detect patterns, not personal stories. The system doesn't know that you're retired. It doesn't know you just sold your boat. It doesn't know you're consolidating accounts after losing a spouse. It simply sees repeated deposits that consistently fall just below the reporting threshold within a short period of time. When that pattern appears, it can trigger internal review. This is where many retirees feel blindsided. They believed they were being responsible. They thought they were avoiding hassle. Instead, the pattern itself becomes the issue. Now let's talk about where this most often happens in real life. The first common situation involves selling personal property for cash. Many retirees sell vehicles, RVs, equipment, or even collectibles. Private buyers often prefer paying in cash. Suppose you sell a vehicle for $11,000 in cash. The safest and simplest step is to deposit the full $11,000 at once. The bank files the currency transaction report automatically, and in almost every case, that is the end of it. What protects you is documentation, a signed bill of sale, the transferred title, your deposit receipt. Together, these documents tell the complete story of where the money came from. If anyone ever asked, which is rare, you have a clear paper trail. The second situation involves family support. It's common for adult children to help parents financially, especially with medical bills, home repairs, or unexpected expenses. If a son gives his mother $15,000 as a gift, that gift is generally not taxable income for her. The cleanest way to handle it is in one transaction, preferably by check or wire transfer, which automatically creates documentation. If the gift is given in cash, the best practice is still to deposit the full amount at once and keep a simple signed letter stating that the funds were given as a personal gift on a specific date. That one page of paper, combined with the deposit receipt, creates clarity. The third situation surprises people the most: moving your own money between your own accounts. Let me tell you about a retired teacher. She spent more than 40 years in the classroom. After her husband passed away, she decided to simplify her finances by consolidating multiple bank accounts into one institution. Emotionally, it was already an overwhelming time. Instead of transferring everything at once, she moved the money gradually. $9,000 one week, $8,000 the next, another amount just under $10,000 a few days later. She wasn't trying to avoid reporting. She wasn't thinking about the rule at all. She simply believed smaller transfers would be easier to manage during a stressful period. Several weeks later, she received a letter asking her to explain the pattern of deposits. Nothing escalated. Once she explained and provided documentation, the matter was resolved. But the experience itself was deeply unsettling. She had done nothing wrong, yet she felt as if she had. The system didn't know her story. It saw repeated sub-threshold deposits within a short time frame. To monitoring software, that pattern resembles structuring. The safer and simpler method when moving large sums between accounts is to use one clean transaction, a wire transfer or cashier's check, and keep the confirmation documents. Moving your own money is perfectly legal. Clear documentation keeps it uncomplicated. When you step back, the pattern becomes obvious. The issue is rarely the money itself. The issue is the appearance of intentional avoidance. There are 5 simple habits that provide strong protection in almost any situation. First, Keep a document explaining why the money exists: a bill of sale, gift letter, or transfer record. Second, retain statements from the original account. Third, save confirmation of the transaction. Fourth, make sure your tax filings align with major transactions when applicable. Fifth, if a bank ever asks for clarification, respond calmly and clearly with documentation, without over-explaining. Now let's clear up 3 persistent myths. Depositing $9,900 repeatedly is not a safe strategy. In fact, repeated deposits just below the threshold are one of the most commonly flagged patterns. Second, only criminals get questioned. Not true. Automated systems flag patterns without judging character. Third, retirees are exempt. They are not. The reporting rules apply equally regardless of age. When you remove the rumors and misunderstandings, the rule is simple. Depositing more than $10,000 in cash triggers a routine report. That's normal. What creates complications is intentionally breaking deposits into smaller pieces to avoid that report. So if there is one principle to remember, it's this: never divide a legitimate deposit simply to stay under the reporting number. Deposit legitimate funds in full. Keep straightforward documentation. Move your own savings in one clear transaction whenever possible. Transparency is what protects you. Documentation is what protects you. Trying to outmaneuver a reporting threshold is what creates unnecessary risk. Now that you understand how the system truly works, you're in a much stronger position than someone relying on secondhand advice. Instead of fearing the $10,000 number, you understand what it really represents: a routine reporting mechanism, not an automatic accusation. Thank you for spending this time with me here on Immigration Alert Center. If this helped clarify something that once felt confusing, share your thoughts or experiences in the comments. Your feedback helps guide future discussions. Stay informed, stay confident, and I'll see you in the next video on Immigration Alert Center.